Hello, everyone, and welcome to Merrill Talks. With me today is Dr. Mark Azzopardi, who's co-founder and executive director at Jesmond Mizzi Financial Advisors. Mark is co-fund manager of Merrill Funds, and together with his team, he manages portfolios for institutional and corporate clients. Mark has over 2 decades of investment experience and started his career in Geneva with Edmund the Rothschild Group. Following his stint in Geneva, Mark moved back to Malta, where initially he held the post of chief financial analyst. In 2002, he co-founded Jesmond Mizzi Financial Services Limited. Today, I will be discussing with Mark the bond market over the past year and a half, his outlook for the asset class, as bond returns are back to attractive levels, and understand how Mark and his team are positioning their portfolios in the current economic environment. Before we proceed, please note that the content of this discussion is for information purposes only and in no way constitutes financial, investment, or professional advice. So, with that, we can move on to the discussion. Welcome, Mark. How are you doing today?
Okay, I'm fine, thank you. And you?
I'm good, thank you, Mark. I'm good. So, Mark, I thought of starting this discussion with having a look at what led 2022 to be one of the worst years for bond investors, and maybe also look at how 2022 shaped bond returns and the role of bonds in portfolios for the foreseeable future. And it's fair to say that it's an anomaly to see safe bonds, such as good quality sovereign bonds, underperforming riskier assets. This was the case last year. However, one has to keep in mind that we entered 2022, which was, I would say, a period where interest rates or inflation was on the rise and stayed at relatively high levels, with very low bond yields, and therefore bonds had no cushion whatsoever to protect investors during periods of volatility. What's your take on this, Mark?
Well, first of all, indeed it was. I would say it was an anomaly. However, one must focus on what caused such an underperformance. I would say that the anomaly stems from the fact that major central banks, because they did not expect to have inflation persisting for long, had to hike rates in a very short period of time. If one were to compare, say, an interest rate cycle and assess the magnitude and speed of hike, let's say if we go back to 2004, nearly 19 years ago, we can see that from June 2004 till June 2006, 24 months, an exact term, there were 4.25% interest rate hikes. So the speed was based on 24 months and the magnitude was 4.25%. Whereas in Europe, we had interest rate hikes in 2005 till 2007 with 2% rate hikes over 19 months. If one were to compare the cycle of 2016, obviously Europe had no interest rate hikes since then. So the most recent one is the Fed rate hike cycle, which was had a magnitude of 2% over 25 months. Now, if one were to compare it to the current rate hike cycle of 2022, we can see that the US Fed had increased the rates by 4.75% in just 13 months, whereas the ECB hiked by 3.5% in just 9 months. Hence, the sensitivity to the curve had a strong impact to the bond market.
Mark, can you tell us a bit more how your income portfolios performed over the past 12 months, namely the Merrill Total Return Income Fund and the Merrill High Income Fund?
Yes, let me start with the main changes first, I would say. First and foremost, we bought short-term bonds and improved the credit rating quality of our portfolio and reduced the duration. Now, from a performance point of view, If one were to look at the following charts, I know it's a busy chart, but we have four lines, line charts. So basically, we have the light blue line, which is being the government bond index. The green line is the investment corporate bond index. The orange line is the Merrill total return, and the Merrill high income is the black line. So as you can see, we have outperformed, both strategies have outperformed the investment corporate bond indices and the government bond indices, mainly for two reasons. I mean, from the Merrill total return point of view, because we had a shorter duration because we actively managed the duration there. Compared to the index, we outperformed the investment corporate index. Whereas the Merrill high income, being it a blend between high yield and investment grade bonds, and typically the high yield are more of a short-term nature because of less duration and less sensitivity curve, had a better performance. And going back to your first question, Gabriel, riskier assets actually outperformed um, safer assets.
Thank you, Mark. Of course, the volatility which the bond market experienced during 2022 is now reflecting in much better returns for bond investors, and it's safe to say that the bond market is currently offering very attractive returns compared to what we have been accustomed to over the past 10 years. Where do you see value for investors who are after income?
Yes, so far it is definitely the short-term bonds, I would say, with high credit rating and I mean both from the corporate point of view, high credit ratings, corporates and sovereign bonds. I mean, if we look at the yield curves at this point in time, you are not paid for duration, so there is no what we call the term premium. So you are not paid to extend duration at this stage from both in terms of absolute return because you actually get or receive a higher interest rate, higher yield at the shorter end of the curve, and also from a risk-adjusted point of view.
Thank you, Mark. Going back a bit, we've heard a lot about recession, brewing recession around the corner because central banks are tightening, consumer spending declining, etc., etc. However, history shows that during recessions, good quality long-dated sovereign bonds tend to be among the best performing asset classes. At the current market yields, I also expect sovereign bonds to provide that layer of downside protection which we expect them to provide during periods of volatility. What's your take on this, and should bond investors be too scared of recessions?
Well, I mean, in actual fact, as you said, as you correctly said, an economic downturn is typically a positive catalyst for high grade and prime bonds, meaning the better quality bonds and safer assets like the sovereign bonds with high credit rating. Whether they should invest or not, I mean, currently, as we all know, the tightening is coming because there is a high inflation. So the current inflation rate is eroding the cash value. So I would say it is very important to limit that erosion by investing in yielding assets.
One final question, Mark. You touched a bit on inverted yield curves, which is, I would say, uh, across the globe. We have inverted yield curves in the US, in the UK, Europe, Australia. Of course, these are all signs that the markets are expecting a recession. How are you positioning your bond portfolios in view of this market expectation?
Well, as I said earlier, I think until we achieve a high terminal rate, so sort of the terminal rate set by the Fed and the ECB, we will still favor short-term good quality corporates and sovereign bonds. From a risk-reward perspective, they are still providing attractive entry levels with yields, which have been seen in the past decade. I mean, just to give you an idea, we are seeing yields in excess of 4% in euro and in excess of 5% in dollar. Once we get an indication, however, of that terminal rate, then longer duration assets may potentially become a value play. To conclude, I would say that during such volatile periods, an actively managed strategy is key.
Thank you, Mark. Thank you for your insights and comments. This is all from us. Thank you for watching. Don't forget to like this video and subscribe to this channel. See you next time.